Hi. I know we're almost near the end, so please bear with me. Promise to make this short and hopefully useful. So the objective today is to walk you through how to assess the relative sort of economic strength and vibrancy of public blockchains. I know Linda's talk was all about private functions of blockchains. What I'm going to be talking about is how you can determine the economic usage of a public blockchain which does not have those privacy features. And today in practice, the vast majority of all public blockchains that are being used are actually pretty transparent. So it's a pretty interesting state of affairs where we have these amazingly deep data sets of all of the transactional data available to mine, and it's useful for a variety of different sort of constituencies. So in fact, I think anybody in this room that is professionally involved in crypto would be able to benefit from looking directly at the data of the sort of economic features of a public blockchain. So if you're a developer, you want to know if the changes, the tweaks you're making to a protocol are having an effect. Maybe you're trying to target a lower rate of fees or something. For builders, you want to build on the protocol which is the richest and most economically vibrant. If you're a user, you don't want to be moored in a tiny network with relatively little usage. And if you're a VC, then you care about platform risk, protocol risk for your portfolio companies. So there's a use for virtually anyone in looking at public blockchain data. But there's also a lot of complications, and the main reason is because these are huge multi-billion-dollar networks. The stakes are very high, and investors look at a lot of these metrics to try and ascertain which blockchains are worth investing in. And as a consequence, it's this adversarial environment where there's huge incentives to make your blockchain look really attractive by spamming it with lots of transactions or lots of contract calls or something. So the other reason is that blockchains tend to be optimized for sort of cryptographic correctness as opposed to easy parsing. So it's kind of difficult to parse these things most of the time. We rely on a bunch of third parties, intermediaries, data providers. It's just difficult to read public blockchains directly. But yeah, so if you look at EOS, for instance, there are many transactions on there which appear to be bot-driven, and that's because of this adversarial nature of blockchain analysis, where incentives are extremely high to sort of insert data into blockchains to make them look very vibrant. So just to start with a very common metric that's seen in the press a lot, the dominance index. It's not the best. I think a normal conventional indexing methodology used in traditional finance would define a basket of assets, equities, for instance, of a fixed set, and have a periodic rebalancing on a monthly basis. Typically, is what happens. The dominance index relies on market cap, and you have a case where a new ICO or a new token launch reduces the dominance of every other asset in the set. So you have this conflation of returns with the sort of total economic weight in the industry. And I think just conventional indexing methodology is a much better way to kind of tease this apart and recapture what actual investor returns are like. The other issue is that the dominance index relies on market capitalization, which is a concept borrowed from equity land, which has been ported over to crypto, which potentially is not the most appropriate concept to be using in this context. So I'll go into that a little bit. So market cap, very popular, most popular website everybody uses in crypto land, CoinMarketCap, of course, has many deficiencies, and I'll just go into a couple of them here. So one is with supply. This chart shows you the uptake of various forks of Bitcoin. And what it shows you is that, because if you want to use your Bitcoin Cash or your Bitcoin Gold or something, you need to actually awaken those units on the new chain so you can transact with them, so you can sell them, so you can start using them. And the interesting case is that, only about 9.5 million Bitcoin Cash were ever awoken, so to speak. And then it's even worse for Bitcoin SV, only 4 million or so were awoken. But the interesting thing is that you look on CoinMarketCap or any of the major ranking sites, and their market cap is assumed to be that of the parent asset, which is Bitcoin, which has 17.5 million units outstanding. So what you have is this kind of like inappropriate inheritance of the supply features of the parent asset, whereas the forks, it's very eminently visible. If you look at the blockchain, you can see, well, this fork didn't really, not all of those units are actually active and economically relevant, but they're still counted in the total calculation, which gives you a situation where you have a very low float, very low sort of circulating supply relative to what the supply is sort of assumed to be. So that's one sort of initial problem. Now this graph is a graph of all of the units of Bitcoin itself repartitioned by the year in which they last moved. So this is something very simple you can do with blockchain analysis. You can determine how old the units of Bitcoin are. And what this shows you is that since 2011, there are about 3 million or so Bitcoins which just haven't moved, period. They're dormant. We don't know for sure if they're lost, but they look essentially like they're totally out of circulation. And then the question is, are these units, these totally dormant units, which haven't moved since 2009, 2010, are they economically significant? Should we be counting them in, a measure of current economic significance, which is what market cap is presumed to be? And, I'm not sure. I don't know if there's actually a good answer on this. But in Bitcoin, in particular, there's about 2-3 million units which are understood to be either lost or like in really deep dormancy or permanently out of circulation. So that's another thing which sort of challenges or undermines this measure. And then another issue you have is variable issuance rates. And this is a problem because people often want to take future inflation rates into account when they're comparing the relative economic strength of crypto assets. So Bitwise, for instance, which is an index provider, they will take the next 5 years of inflation into account for a crypto asset. So they'll dilute it 5 years into the future and then compare it on that basis. So that's their attempt to reckon with this. But if if I've just aggregated a few units here, a few crypto assets here, they virtually all have different inflation rates, terminal supplies. And their annualized inflation is different from all of them. Some of them have an uncapped supply, some of them have a fixed supply. It's really difficult to make consistent comparisons. And I think this is an issue, again, that kind of plagues market cap. So what are some other measures? Luckily, there are plenty of other ways to compare the sort of economic significance of crypto assets. Transaction count is one of the most popular. If you read any white paper, it'll say our TPS is 100,000 per second or something. Transaction count's an interesting case because many would say that a Bitcoin or Ethereum transaction is not exactly one-to-one comparable with an EOS or Tron transaction. If you look at this chart, the two chains with tons and tons of transactions recently are EOS and Tron. But both of those have more permission validator sets. So they've made decentralization trade-offs to achieve that high transaction count, which is similar to the way that Visa, for instance, has kind of a more permission validator set. So the question is, are transactions on open permissionless networks like Ethereum and Bitcoin, are those directly comparable to those where the validator sets are closed and the decentralization has been reduced to some degree? And so I think that maybe challenges the usage of kind of naive transaction count to some degree. So then, now we're coming to the real meat of it. One of my favorite measures, just simple on-chain transaction value. And I say on-chain, I don't mean like within exchanges, but actually transactions which settle on the blockchain directly. And on Bitcoin, you'll have a couple $1 billion a day will settle to the blockchain, and we presume those to be economically significant because it's usually costly to transact on a blockchain, especially if you're in a higher fee environment. So it's not like exchange volume, which can be wash traded trivially. It's slightly more expensive and more difficult to create those wash trades on a blockchain, although it does occur. And that's why you have adjustments to remove that kind of additional churn. But I do think the economic, dollar-denominated throughput of a crypto asset or a public blockchain system is among the most important measures. So you can actually rederive indices, comparisons of crypto assets by taking averages of their transaction value. And one interesting feature is if you do this, Ripple actually punches above its weight on a market cap basis, but it has a comparatively less, a lower level of transaction value that actually settles on the Ripple ledger. And so if you were to reconstitute an index according to transaction value on chain, you would have totally different weightings. Although actually for Bitcoin and Ethereum, they look much the same. So now we're getting into some sort of more exotic metrics, and this one only applies to proof of work assets, which I know are not exactly in favor these days. But so the features of mining are such that miners often operate such that marginal cost is close to marginal revenue. So they have fiat denominated costs. They have to sell off all the new coins that they mine. And the net effect of this is that the miner revenue can be presumed to be a rough approximation of the net inflows into the coin, because you can make this rough heuristic where you assume that those miners are near constant sellers, although this isn't always the case in practice. And if you take this to its logical conclusion, you get a situation where you can guess at the net inflow into a proof of work currency. And this is a methodology that's been around for a while. I call it ThermoCap. You could call it anything. Bitcoin's market cap today is 69 billion, but the estimated net inflows using this methodology are 11 billion. So, you can then compare assets based on estimated proof of work derived net inflows, and you can sort of reconstitute it this way. Interestingly, it actually looks similar to if you compare it, you break it down by market cap. Moving on, looking at the chain directly allows you to do some more interesting things. Realized cap is a case where you take each coin on a blockchain and you actually measure it based on the price when it last moved. So you're not taking all the coins and assessing them at the current market price. You actually assess them at the price when that coin was last active. And what this does is correct for inactive coins which haven't moved in 10 years or something. So you can find sort of maybe more realistic sort of churn or transaction indexed approaches of sort of aggregate economic volume. And just to wrap up here, this is a very simple measure that I think is actually very informative, which is quite simply, what are people paying to transact on these chains? If we consider public blockchains as corporations, aggregate fees paid would be the revenues. And to me, they show a certain amount of defensibility. Because if you as a blockchain can convince people to come and transact on you and pay really high fees, then you're showing that there's some defensibility there, that there's some sort of premium sort of perception of your block space that it's worth transacting on. And actually, if you look at the top 10 assets, really only Bitcoin and Ethereum have meaningful on-chain fees. In fact, EOS has gotten rid of fees entirely. The point here is that fees are assumed to be the security driver in the long term once inflation goes away, both for Bitcoin and for assets similar to Bitcoin. So if there's a high baseline of fees now, that's in theory a good idea. It's a good situation so you can reckon with the reduced inflation in the future. Lastly, this is a metric which takes only addresses. It counts up the number of addresses which have at least 1/billionth of supply. So in Bitcoin, there's about 5 million. Ethereum has about 2.5 million. So these can be understood as the real on-chain owners of the crypto asset. A lot of people own Bitcoin and Ethereum indirectly through exchanges. This counts up only the people that own it directly. In my view, it's a measure of kind of dispersion of the supply of the asset getting distributed in a larger and larger pool of people. But interestingly, if you look at some of the Bitcoin forks on the chart, you'll see that they've become actually reconcentrated as ownership has become less dispersed from the fork period onwards. So just quick takeaways from this talk. There really is no single one metric you can use to determine the economic significance of a public blockchain. You just kind of have to build a pattern based on, I think, network level analysis is really informative, but there's no one metric which alone satisfies everything. And market cap certainly, is deficient in a number of ways. I would say it's also an adversarial science. So we see all the time adversaries trying to pollute the data and promote a certain chain, promote a certain perspective by injecting additional churn or transactions into the mix. So it is really this game of cat and mouse. But if you take a holistic approach and understand public blockchains, these parallel mini economies that exist online, I think public blockchain analysis can be an extremely powerful tool for virtually anyone that uses them. Thank you.
Great presentation, by the way, thanks. You didn't really talk much about your firm, like how long have you been around, when you based, how big of a data team do you have, how long have you been doing this, how much money do you manage, et cetera?
Sure, so I'm a partner at a venture firm called Castle Island Ventures, which is Boston-based. We manage $30 million. We've been around since 2018. A lot of the charts here came from a startup that I founded 2 years ago called Coinmetrics, and the total objective of that startup initially was an open source project, is to demystify blockchains and allow people to make inferences. Eric.
Yeah. Do you have the mic or is it? Oh, okay.
How do you feel about Bitcoin dominance as a metric?
Were you here for the start of the presentation?
No, did you cover this?
Yeah.
Okay.
I'll send you the slides.
Yeah, great.
I don't like it. It's just not a scientific way to create an index. I think normal indexes, you define a basket of assets with a fixed constituent set, and then you rebalance as assets enter the kind of relevant criteria zone. And what that allows you to do is sort of like recapture what a typical dollar invested in that category would yield you. Right. Whereas the dominance index, dominance will be reduced if there's like a new ICO or a new stable coin, but that is sort of irrelevant from a returns perspective.
Right. So if to refine that question, if someone wanted you to predict sort of how the economic significance of Bitcoin compared to altcoins in like 2025, how do you feel about where that metric's going to end up?
The dominance?
Like an improved dominance metric that accounts for liquidity and
I would say the naive dominance index will continue to decline for Bitcoin, because I think there will be a lot of stuff that gets sort of tokenized, and there'll be lots of stable coins, and so Bitcoin's weight will naturally decrease. But it's hard to make a prediction, but I think if you use some of the alternative metrics, you see that Bitcoin has sort of roughly 60% market share. So I wouldn't see any reason for that to really change meaningfully.
Cool.
As you think about Lightning and other layer 2 solutions being built on top of some of these blockchains, how does that impact the way you think about data on those?
That's a great question. So Liquid is a layer 2 solution on Bitcoin where you have the ability to transact confidentially. What you can see is the peg ins and the pegs out. You can't necessarily see what's happening on the sidechain. And with Lightning, of course, there's sort of onion routing, so you can't actually see how many transactions are occurring. But you can still see, it's evident on the base layer how much capital is allocated to Lightning. And we actually run a bunch of Lightning nodes, so we have reliable guesses as to what's going on over there. But it'll make it more of a challenge, but more interesting as well.
Great talk, Nick. You mentioned early on that you guys are looking at permissionless public blockchains, and then you also mentioned these are mini economies in themselves. Have you looked at any good token economics models for proof of stake public blockchains recently? Or do you have thesis on how to think about these token economies?
I would say much in the same way as you contemplate a proof of work blockchain. I think the distinction there comes down to whether the consensus mechanism works or not. We certainly heard about some proof of stake ideas today. But ultimately, the question is, can you induce people to transact on your chain, and can that provide a reliable level of fees or either inflation funding to make the security work long term? I think the challenge is still the same, which is, can you really induce transactional activity on your blockchain? And the security guarantees that you provide might be part of that analysis, but I wouldn't say meaningfully different, from the proof. I don't analyze them in any distinct way.
Question. I kind of missed the earlier part, so apologies if you already covered this. But with some of the crypto assets, like some people speculate and kind of treat them as equity, but then there are a lot of metrics, including some of the metrics that you kind of showed that kind of like show how you could quantify them as commodities of sorts. Do you think that treating and creating, I guess, just like capital markets, I guess, products that kind of like treat crypto assets more like commodities or more like equities or securities kind of helps with price discovery? Do you think that do you think that the beauty of crypto is that it can kind of like mesh between both of them, or do you think it kind of like sits firmly in commodity land or firmly in like security or equity land?
I think building a reliable taxonomy of these assets is an absolute must if you want to deeply understand them, because we, as you say, we do have equity-like crypto assets. So, you know, I would say MKR or BNB, those are more like equity-like assets in that they're meant to recapture the features of equity through governance and maybe cash flow dynamics. And then on the other end, you've got you know, the just currency like, you know, call them virtual commodities, which have nothing in common with equity. So I think a disaggregation is absolutely warranted. And if you conflate them, then you actually make a lot of mistakes, I think.
Most of the research or the presentation you made were kind of looking at the macro chains. Do you, in your own fund, look at how any of this public blockchain data can be used for like micro trading, so momentum signals or arbitrage or things like that?
Yeah, the objective here was really to describe the tools that are useful on a macro and kind of long-term basis. But I think network data is really fruitful for shorter-term signals. I certainly know a lot of traders that use it actively on a daily basis or you know, those shorter time frames. In particular, you know, lots of traders will look at like the velocity of a chain and the supply that's active within, you know, the last week, the last 30 days. All right. Thank you very much.